According to research from the National Low-Income Housing Coalition, in 2024, there were only 2 counties in all of America where a full-time worker on local minimum wages could afford to make rent on a modest 2-bedroom apartment. For the sake of rounding things out, the most recent update from that same report found that there were now no counties that would be affordable. Even for people on significantly higher incomes, the dream of actually owning a home, even one that comes with a lifetime of mortgage commitments, is seeming increasingly out of reach. The median first-time homebuyer is now almost 40 years old, and that doesn't even account for the people who will never own a home at all. Businesses and the government have seen this problem and attempted fixes like 1% down payments, and most recently, 50-year mortgages to try and stretch people's personal finances until they can squeeze into the property market. But as almost everybody is aware at this point, these fixes have only made home prices even worse. With so many regulatory own goals, it does raise the obvious question. So much of our collective wealth, retirement planning, and industry depends on selling increasingly expensive buildings back and forth to one another. That is before they fall apart. So, the question is, especially amongst the groups that really make these decisions, do we actually want affordable housing?
Some big numbers coming out of the housing market today, and they're not looking pretty if you're looking to buy or rent.
In my 30s, working a professional job and have the ability to afford a 1-bedroom apartment doesn't feel like I'm begging for largesse here, and yet it also feels so unattainable.
There's been an absolute epidemic of house flipping in the U.S. over the past several years.
Sometimes I get really sad because I know that I will never be able to afford a house.
The median family now needs to spend almost 40% of their income to cover the median loan repayment, and that's before counting income taxes and other expenses like insurance, property tax, and maintenance. In certain cities, this number is over 90%, which effectively just means that the average family cannot afford the average home. For most people, the only feasible way to buy a house is to have just sold a house, with first-time buyers now representing the smallest share of the market since economists started collecting this data over 4 decades ago. The numbers are not great, but at least they seem to suggest that affordability can't get any worse, right? Now, before we get into crushing your hopes and dreams, there is some good news to get out of the way first. The median sales price of a household in America over the last 3 years has actually trended downwards from its all-time peak in 2022. Now, a lot of people will point to this as an early sign that building initiatives and affordable housing policies are starting to work. However, while this chart looks like it could be heading in the right direction, there are some things that you should know about the data it is presenting. Median sales price can only track the homes that actually get sold, which is still down significantly. According to the National Association of Realtors, there are now almost 25% fewer houses trading hands every month than there were before the pandemic, and almost 40% fewer than there were just 4 years ago. Now, you probably already know some of the reasons behind this. People who were able to lock in sub 3% mortgage rates 4 years ago are simply not willing to sell their homes even if they move to a completely different city. They would rather rent out their existing home to someone else while they go and rent a house themselves. This trend has actually been even more important in other markets, so remember it for later. This number also depends a lot on the type of houses that have been selling. The reality is that the people who have been forced to sell their home are more often than not those on lower incomes, and simultaneously, the only homes that buyers can afford are more likely to be budget-friendly starter homes. The Case-Shiller Home Price Index, which accounts for these variables, still shows that home prices are increasing pretty consistently year on year. But even with that nuance around the actual data, there are levels to this game. Even with all of the problems that the American housing market is causing for society, we actually have it pretty good compared to almost every other country on Earth. According to the numbers anyway. There are probably already some Canadians and Australians in the comment section telling us that we have no idea how bad it can get. There is probably also someone from London telling them that they have no idea how bad it can get. But what most of them probably don't realize is that there is a level of housing unaffordability even beyond this that honestly puts the rest of us to shame. In the hierarchy of housing crises, we are still on level 1. So then what would it take for us to step up our game, so to speak? Well, the first level above us would be cities in places like Canada, Australia, New Zealand, and certain high-income parts of Europe. Across America, our average house price to income ratio is 3.4. This is simply a straight calculation of how many years of the average household after-tax income you would need to earn to buy the average house. It's not a perfect measure, but we will get into the problems with it soon. But as a starting point of comparison, the UK has a ratio of 8.7, Australia 8.4, and Canada 9.5. If our real estate market started to look like these places, then the average home price could easily double or triple from where they are now. So the obvious question is, how is that even possible? Well, there are 4 big differences, so let's go through them from least to most concerning. The first difference is that this data adjusts for home sizes and scales all homes to 90 square meters, which is the equivalent of roughly 970 square feet. Per square foot, our homes are significantly cheaper, but instead of making them more affordable or just constructing them out of something other than chalk, popsicle sticks, and hot glue, we have instead chosen to just make them bigger. Now, this is made worse by the fact that we generally do not share our households nearly as much as people do in other countries, although that is starting to change out of necessity, but I am getting ahead of myself. Either way, it's not exactly fair to compare $500,000 7-bedroom McMansion to a $500,000 studio apartment, even if this trend has caused other problems like urban sprawl, huge transport costs, and more expensive utilities and maintenance. But even accounting for home sizes, that still doesn't explain the whole difference. If by some miracle we were willing to actually give up our 3rd guest bedrooms, house prices still have a lot of headroom to rise much higher than they are today if we are not extremely careful around some major issues. So it's time to learn how money works to find out how much worse home affordability can really get. This week's video is sponsored by Built, and if you are paying rent every month without earning anything back, this is for you. Built is the loyalty program for renters that lets you earn points on your monthly rent payments no matter where you live. These points can be used for travel with major airlines and hotel partners, Lyft rides, Amazon.com purchases, fitness classes, member-only experiences, and more. Plus, when you link any credit or debit card, you unlock access to benefits from over 45,000 local merchants, so you earn Built points on top of your regular card rewards. I love the idea of redeeming points for a week and give it away through the Built travel portal, because if I am already paying rent every month, I might as well get closer to a trip. And if you are linking a card for everyday spending, always stay responsible and pay it off in full so you can enjoy the points without running up a balance. Built points are ranked the most valuable point currency by the Points Guy, and joining is free, which makes earning on rent feel a lot more satisfying. Sign up through the link in my description or the QR code on screen to earn points on your rent payments, and make sure you use my URL so they know I sent you. So one other thing that we have going for us that has kept our real estate market in check, if you could really call it that, is that we are actually pretty good at spreading out. Now that doesn't just include the car-centric urban sprawl that we have become famous for. Sure, our cities are generally more spread out than our friends in the old world. But we are also more spread out between these cities as well. Demographers use something called urban primacy, which is a rough indication of how concentrated a population is within a single city. All it does is measure what percent of the country's entire population lives within a single center. Here in the US, about 7% of our people live in the New York metropolitan area. Now, that's still a lot of people, but when compared to most other high-income countries, even those with more space than us, it's actually incredibly low, indicating that we haven't put all of our real estate eggs in one speculative basket. Now, this is actually even more significant than it looks, because we have a lot of decent runners-up. You could add together our 10 largest cities combined, and it would still account for less than a quarter of our population. A small caveat is that we are actually so good at spreading out that this data is open to some interpretation, because it is difficult to know exactly where to draw statistical borders around population centers. Either way, if we compare our urban primacy to a country like Australia, we are already significantly more diversified. But if we include the second largest city in this calculation, then almost half of their population lives in just Sydney and Melbourne. This urban concentration drives prices in more ways than you might expect. Firstly, of course, if everybody is fighting over space in just 1 or 2 cities, there is less supply and more demand for small areas of space, even if the rest of the country is very large. But less intuitively, it also creates the same problem we are seeing in the stock market right now. If just a few centers dominate everything else, then they attract most of the investment and get most of the opportunities. In cities like London, Sydney, Auckland, and Vancouver, this has created a trend where people will live and work in big cities with jobs and opportunities. But since they won't be able to afford a house there, they will use their higher earnings to buy a house in a different city and rent it out. This rent vesting strategy is becoming far more common back here in America, thanks to people who tried to move out of major centers during the pandemic, but now don't want to sell their homes because of those low locked-in interest rates. This has basically let us outsource the housing crisis into a lot of cities where people don't earn enough to compete with the few centers that are driving the most growth. These other countries have had a big head start, but we are heading in exactly the same direction. A report by the Bureau of Economic Analysis found that as of 2024, just 31 counties accounted for more than 1/3 of the country's entire economic output. This statistic has only been getting more concentrated, as certain industries like finance and tech have become increasingly dominant, while other industries have seen continual declines. Now, there was a really nice chart prepared in the Bureau's report showing this, but their site has gone offline during the government shutdown, so, for now you are just going to have to trust me, bro. Anyway, as job opportunities continue to consolidate, we are already seeing house prices in certain cities outpace the already elevated prices everywhere else. For a property roughly the size of a 2-bedroom apartment, the most unaffordable city in America is New York, where average prices are 12 times average disposable incomes. This is close to what we see in cities like Sydney and Vancouver. They are slightly less affordable, but the difference is a lot smaller. The problem is, this basically means that in these countries, half of their people deal with housing affordability problems that are just as bad as New York. For now, we at least have the luxury of alternatives. But if industries continue to consolidate, more and more of us are going to have to make the same decisions, picking between a place where we can afford to live and picking a place where we can get a decent job. But it gets worse. A 2-bedroom residence in Sydney costs 12.5 times the city's average household disposable income. In Beijing, Shanghai, Taipei, and Colombo, that ratio is approaching 40 times. Someone would need to dedicate more than 30 years of their entire take-home income to afford a home that would be considered extremely small by our standards. These cities are often ignored in the usual lists talking about the most unaffordable places to live, because they are not in the OECD, and their outright prices are not quite as high. But they still show that we are not even approaching the limits of how bad the housing market could get. Property in these cities are almost as expensive as similar properties in major American cities, but the average wages are significantly lower. So, how do these people afford it? Well, their homes are, on average, much smaller. According to data compiled by respective housing departments, the average American has approximately 900 square feet of space per person in their homes. In cities like Hong Kong, Shanghai, and Seoul, the numbers are between 170 and 300 square feet per person. People afford these homes by banding together savings from multiple generations and then living in cramped conditions, often while paying off extremely large mortgages. Now, if you are thinking it, then yes, you are right. Culturally, multi-generational housing is much more common in these countries. However, when people are living in a 2-bedroom apartment with 8 other people from 3 generations, they are doing it out of necessity rather than tradition. Now, I want to make 2 things clear. The first is that, to be fair, we are a long way from this kind of situation, for now. But the second is that it's pretty dangerous to assume that the unaffordable housing problem has a natural limit. If we aren't very proactive with policies around home construction, responsible lending, and new development, there is nothing to stop us trending in the same direction. In fact, we kind of already are. For the first time in over 160 years, the number of people living in the average American household actually went up, despite declining birth rates, simply because more generations were living in the same home. At the same time, in more than 50 years, average houses started to get smaller. Now, I would love to conclude that we are all simultaneously getting closer to our families and more environmentally conscious at the same time. But let's be honest with ourselves. We are doing this because we have to. What almost everyone seems to be asking is, why don't we just build more homes so young people don't get stuck living with their great-grandma? Well, we've been trying. The number of houses in America has never been higher, and even on a per capita basis, we are doing well by historical standards. What's more is that if you looked around most big cities in the country, you would be forgiven for thinking that we are in the middle of a development boom, because we kind of are. The problem is that these new homes are almost entirely made up of high-end luxury apartments or McMansions that are out of the price range of people who don't already own real estate. Even those who have benefited from increased home prices can't keep up with these new developments, which is why hundreds of thousands of these properties are now sitting empty across the country. So then, why don't we just build what everybody says they want? Affordable, medium-sized, medium-density housing. Well, the good news is that there are dozens of companies that are raising hundreds of millions of dollars to fill this potential gap in the market. The bad news is that they are almost certainly going to fail, and that's if running an honest business was their actual priority in the first place. Okay, so the price to construct a home has increased a lot, and there are a lot of reasons why this is happening. But most of those have been focused on recent changes that have occurred since COVID, and we will get to those. But a longer-term issue is that we just kind of suck at building houses. According to the Bureau of Labor Statistics, construction, and in particular residential construction, is the only major industry in the country that has not become more productive since 1987 when they started collecting this data. Productivity measures how much output we get for every hour of work that we do. For example, in the motor vehicle industry, new technology and better manufacturing processes means we are making 3 times as much value in automobiles for every man-hour of work as we were back in 1987. Admittedly, this can sometimes be a little confusing, because cars have become more expensive, so this doesn't directly mean we are making 3 times as many cars directly, but we are making more cars that are more complex and more valued in the market. In the commercial equipment industry, we are now almost 30 times as productive as we were back in 1987. This shouldn't be that surprising. It's the basis of our GDP, which is almost 6 times higher than it was back in the mid-1980s. But over that same time, construction has actually become less productive. To oversimplify, we are only getting 80% as much house for every man-hour spent on construction, even though in almost every other sector of the economy, we are much more productive. This drop was almost so unbelievable that the Fed commissioned an investigation into the sector to find out if they were messing up the data somehow. The report tried to make the argument that maybe new home construction was just of a significantly higher quality, which is why it was taking longer. And well, this probably isn't surprising to anybody who has toured a newly built home recently, but there was no evidence that building standards have measurably improved.
A 30-year mortgage at Michael's age essentially means that he's buying a coffin. If I were buying my coffin, I would get one with thicker walls, so you couldn't hear the other dead people.
After looking into almost every possible issue with their data, the conclusion was that, nope, the construction industry really had gone backwards, which begs the question, why? Well, there are a few reasons. The first might come as a shock to you if you have watched this channel for a while. Yeah, no, I'm kidding. It's private equity. Trade businesses like roofers, plumbers, carpenters, and general builders have been some of the most popular acquisition targets for private equity investors over the last 2 decades. The way this typically works is that a large PE firm will target a regional market and slowly buy up all of the electrician businesses in a given area. Once they have an array of these companies, they will centralize sales, bookings, administration, and other overhead to theoretically save on costs and make these businesses more competitive in the marketplace. Now, if that's where the business strategy stopped, it honestly wouldn't be that bad. Business owners have a way to sell their business to fund a retirement, and lower operating costs could, in theory, be passed along to consumers. But of course, in reality, it rarely works like this. To acquire these businesses, PE firms borrow a lot of money so they don't have to put in too much of their own money. That debt needs to be repaid, so realistically, what they actually end up doing is replacing the cost of hiring lots of independent local staff with the cost of paying back lots of debt, leaving little room for actual cost savings. And that's assuming they wanted to give you a good deal in the first place. It can be really hard to tell when a business has been acquired because on the surface, they usually keep their old branding. This means it's possible that if you do the responsible thing and get 3 quotes from 3 different plumbing companies to work on building your new home, you might actually be talking to the same business 3 times over. And they don't exactly have much incentive to compete on price against themselves. To put this into perspective, Goldman Sachs is technically now the largest HVAC company in America. The impact of local micro-monopolies was something that the FTC was starting to pay attention to. However, officially, they are no longer looking into this problem. This explains part of the reason why housing has become more expensive, but theoretically, the free market should slowly undermine these profiteering businesses, right? Well, even with all of these tactics, the industry is struggling financially because of the productivity problem. And according to the data, billions of dollars worth of outside investment has only made it worse. But don't worry, the tech bros have a solution. Okay, so there are 2 main reasons why American productivity has grown so much in most other industries. The first reason, as you could probably guess, is technological improvements. The example from earlier, car manufacturing looks very different today than it did 40 years ago thanks to a lot of automation. Other industries like tech have developed even further. According to company financials, Apple makes $2.4 million in revenue per employee. That's because in new roles like tech development, a few man-hours of work on a new feature can be leveraged over billions of devices within their ecosystem, potentially making hundreds of millions, if not billions of dollars. Going all in on technology has had its problems, but it has made our economy look really good, at least on paper. The second reason American productivity has improved in most industries is not really because we have become more productive at our jobs, but because we have taken the least productive jobs and outsourced them overseas. Business majors and economists call this the service pyramid. The people at the bottom, in the primary sector, harvest the resources in mines and on farms. The people in the middle, the secondary sector, turn those resources into products, and the people at the top, in the tertiary sector, coordinate everybody else. Over the last 50 years or so, we have been moving the bottom of the pyramid to wherever has the most resources to harvest, and the middle of the pyramid to whoever has the largest and cheapest workforce. That left just the creamy jobs up here at the top for us Americans, which are theoretically the most valuable. Someone working on a production line making Labubus can only really generate so much revenue in an hour no matter how good they are at their job or what kind of machinery they are using. Someone running a marketing campaign for all that glorious consumer slop can make a lot more. It's a cool trick that definitely didn't have any unintended consequences like gutting entire industrial regions that used to be the middle of the pyramid. But we couldn't really do the same thing with construction. A residential construction site today looks roughly the same as a residential construction site from the 1980s. Builders use slightly more modern tools and materials, but the change hasn't been nearly as drastic as it has been in factories and offices. And because a house is built where it stands, we haven't been able to outsource these jobs either. Although, to be honest, we kinda have. We will need to talk about that later. But before that, we need to look at how the venture capitalists are planning to change this broken system. If you've been paying any attention to the construction industry, or you follow any real estate influencers, you've probably seen a lot of new companies raising billions of dollars to build homes in factories. The idea actually makes a lot of sense. If homes are mass-produced in a controlled environment like a factory floor, then we could use the same kind of automation techniques that made things like the car industry more productive while residential construction remained stagnant. Mass-produced homes could be designed once and then copied like any other mass-produced product to reduce unit costs instead of the current standard practice where almost every home is a one-off custom design. Building within a controlled environment like a covered factory floor also means that quality control could be more carefully monitored and delays due to inclement weather wouldn't be a factor in construction times. For the companies themselves, the business opportunity is even bigger than that though. If homes become mass-produced from broadly recognized companies, there is an opportunity to make a lot of money from branding correctly. Your home probably doesn't have the builder's badge on it like your car does, but factory-produced home models that are recognizable could charge a premium over regular homes if they are branded correctly. So it's a promising business opportunity for all parties, if it works. The problem is, it hasn't worked. Several different companies have collectively raised billions of dollars to bring these homes to market, and they have done it using a variety of questionable financial strategies. Katerra, which promised to be an end-to-end factory home builder, raised $2 billion from SoftBank, and it was once dubbed the WeWork of construction. And I guess they were right, because it collapsed and filed for Chapter 11 in 2021. Vive raised hundreds of millions of dollars at a $1 billion valuation from Silicon Valley investors before it was wound down in 2023. Connect Homes, Mighty Buildings, Blue Homes, Rad Urban, Factory OS, Guerdon, and Integra all followed the same playbook. Lots of investor hype with big fundraising rounds before realizing that building a house in a factory is really hard and then go bankrupt. The investors know that home construction is an industry ripe for, disruption, but they underestimate just how expensive these facilities will be to build and operate, and overestimate how much people want to spend on what amounts to a fancy mobile home. Today, companies like Boxable are, again, raising hundreds of millions of dollars for their factory-made tiny homes. The company sold just 51 tiny homes at below cost in 2024, but has still claimed a valuation of $3.5 billion. Now the good news is that the venture capitalists aren't really falling for this anymore. Even SoftBank has learned their lesson. The bad news is that this means these companies are now raising money from regular people using regulatory loopholes around crowdfunding. Boxable, for example, has raised more than $200 million from more than 50,000 unsophisticated investors according to their website. As with a lot of these businesses raising money from the public, they have capitalized on a tenuous connection to Elon Musk. The business gained a lot of attention based on the false reporting that Musk was living in one of their homes outside the SpaceX starbase in Texas. The channel Wall Street Millennial did a great deep dive on the other aspects of the business in a video that I can only describe as damning. One other channel called About Here also did a great report on the technical limitations of all prefabricated housing. It was focused on the Canadian market, but would apply to pretty much anywhere, so I will leave a link to both of those videos down below. The point is that the process of building homes is really hard to improve upon like we have with other manufactured goods, and that reality is now coming to head with more immediate problems in our economy. So remember when I said that we couldn't outsource home building jobs like we could with those old factory jobs? Well, in a way, we sort of do. According to the Harvard Joint Center for Housing Studies and Pew Research, around 14% of the construction workforce in America is composed of undocumented workers. According to the reports, that share is even higher in trades like drywalling, roofing, painting, and flooring. Any system that relies on a vulnerable or desperate source of labor to skirt unions and minimum wage laws wasn't really working as intended in the first place. But no matter your politics on the recent crackdowns of undocumented workers, the simple fact of the matter is that this will put upwards pressure on construction costs, especially in a handful of particularly overleveraged cities. In fact, this has already happened before. A study tracked construction costs between 2005 and 2013 after the rollout of the Secure Communities program, which was, according to the administration at the time, a program for the arrest and removal of public safety and national security threats, those who have violated our nation's immigration laws. The study found that an arguably much less severe crackdown led to a 19% increase in construction costs over the measured period. Today, on top of that, there are the tariffs. Basic materials like copper wire could soon attract import duties as high as 50%, and higher interest rates, which could also impact building more than you might expect. It takes at least a few months to build a house, and during that time, developers need to own the land they are building a house on, and they usually buy that land with a loan, and those loans usually have higher interest rates than you would get on a typical 30-year mortgage. As interest rates have increased, the interest expense of just holding on the land to build a house on has also increased. And that price will eventually get passed on to you, assuming you have been skipping your avocado toast. These are called holding costs, and the longer it takes to build and sell a house, the worse they get for the nation's home builders. To make matters worse, tariffs and interest rates could combine forces to pummel new home construction together. If prices rise because of tariffs, the Fed may be forced to raise interest rates to combat inflation, which could further increase holding costs, further increasing building costs. Now, it's not clear if or how that's actually going to play out. But what is clear is that these challenges could not have happened at a worse time in certain cities. American real estate is not a monolithic single market. Conditions can be very different in different cities at different times. And right now, the trendy cities that saw a huge influx of internal migration during the COVID remote work boom are suffering the most as people move back to traditional commercial centers as they are called back into the office. According to data from Construction Coverage, an industry insurer, cities like Denver, Dallas, and El Paso now have the largest supply of housing inventory, although Florida has seen the largest increases statewide. So what we have done is built too much housing in cities that people are moving out of, and now made new construction prohibitively expensive for the cities that people are moving back into. So yeah, we've been building more houses, just in the dumbest way possible. So these foolish policies making it harder to buy houses in places people actually want to live have a lot of people storing up money for a down payment and waiting for a market crash. There has to be one soon, right? High prices aren't good for many people. Buyers can't afford a home, renters are stuck in a market where more than ever they need roommates to afford rent. And even though 2/3 of Americans own their own home, high prices aren't that great for them either. If you are one of the lucky people that own a home and you sell it for a record price, you still need to buy another home, which is just going to cost you a record price, leaving you no better off overall. While you own your home, you are going to pay higher property taxes, and if you do sell your home to buy a new one, you might have to pay capital gains. Most homes in America are now selling over the IRS's Section 121 exemption of $250,000 in profit since you purchased the home. So, if your home is worth a lot more than you bought it for, and you don't want to live on the street once you sell it, the only person you have really made money for is Uncle Sam.
Congratulations, you played yourself.
The only people who are really winning off that own multiple properties in addition to their primary residence. If the prices are too damn high, then the best thing you could hope for is a market crash, right? Wrong. I am once again here to crush your dreams and tell you that a housing crash would probably only make it harder for you to buy a home for 3 simple reasons. The first reason is that if you are not in a financial position to buy a home right now, a real estate crash would put you even further behind. Today, you can buy a house with as little as 3% down from lenders across the country. So if you can't get into a house right now, there is probably something other than the down payment standing in your way. And unless house prices drop by 97%, you aren't going to be able to pay cash. According to the Department of Housing and Urban Development, average house prices fell by just 20% in 2008 from their peak in 2007. This was the worst housing collapse in history, so a 97% drop is unlikely. So that means if you can't buy a house now, then even after a market crash, you are still going to need a mortgage. According to a survey commissioned by NerdWallet and conducted by the Harris Poll, 37% of non-homeowners said they didn't have enough saved for a down payment on a mortgage. But a larger group, 42% of respondents, couldn't buy a home for a much more annoying reason. Lenders want to ensure 3 things when you borrow money from them. They want to make sure you have a down payment, the bigger the better. They want to make sure you have good credit, and they want to make sure that you can make your payments. The systems and criteria that lenders use to determine your ability to repay a loan are made up by the risk departments at the banks, and are kept private because it's considered a business secret. Normally, these rules are highly risk-averse, which is why you might get a mortgage application declined if the bank decides that you can't make repayments even if your repayments would be less than you're currently paying in rent. Every lender has a different set of rules, and they can change them at any time. Income from a full-time job is treated differently to part-time or gig work income. Some banks prefer income from business owners, and some won't lend anything to them. I wanted to buy a house at the end of last year, but when I told my bank that my income came from YouTube videos, they politely but firmly told me to get out of their office. Lenders also treat expenses like student loans, dependent family members, and other debt payments differently as well. All the different rules can get confusing, but they all have one thing in common. If the risk department says that home lending is getting risky, they are going to make it even harder to qualify for a mortgage to balance that risk. After a housing crash like 2008, lenders got much more conservative with who they would lend that money to, which back then was a good thing. But now, in 2024, if your income is not good enough to qualify for a mortgage now, you are going to have even less of a chance to qualify for a loan if real estate crashes. According to the National Association of Realtors, the biggest drop ever in the number of homes being sold in America came after 2008. This should have been the perfect time for the number of home sales to jump because prices had fallen significantly. The number of listings was inflated from foreclosures and interest rates were at record lows. But what actually happened was exactly the opposite. There were people that wanted to buy these houses, but nobody would give them any money to do it. And unfortunately, that's just the first reason. Talking about a real estate crash is one of the most popular finance subjects here on YouTube. Videos warning you about the imminent real estate collapse have regularly been getting hundreds of thousands of views for years. Any day, they might come true. The reason these videos are so popular is because people think that if they are right, then this could be their one chance to buy a home. Some influencers even talk about the investment opportunity that a post-crash real estate market could present. And aside from the titles and thumbnails, some of these videos do make a compelling case. I am trying to be a bigger person in 2024, and I'm not going to name any names. Instead, just focus on the subject. So, I am just going to list a long list of problems you are going to face if you try to buy the dip in real estate. For house prices to fall, one of three things needs to happen. The first thing is that buyers across the country lose their purchasing power because of mass unemployment or because banks stop lending them money to buy a home. The unemployment rate is near all-time lows, and if banks halt lending, then that's not going to help you buy a home unless you plan to pay all cash. If unemployment does rise, then young hopeful homebuyers are likely to be the first people laid off. You might be lucky enough to avoid getting fired and convince a bank to give you a loan, but there are other groups who don't need that luck. In 2011, the investment bank Morgan Stanley sent out an industry report to their clients titled Housing Market Insights, a rentership society. The report opens with the bank's analysis that after the subprime mortgage crisis of 2008, the combination of falling home prices, limited mortgage credit, continued liquidations, and better rental options is fundamentally changing the way Americans live. They were advising their clients, who are either institutional investors or ultra-high net worth individuals, that regular Americans were being evicted, nobody could get a loan, and people that lost their homes needed a place to rent. So it was a perfect opportunity to buy up residential property while nobody else could and jack up rents on people that had been evicted. The Morgan Stanley report was horrendously tone-deaf, but it wasn't actually wrong. Today, the average American home earns more than the average American, which is why the second reason that housing could get cheaper is even less likely to help you buy a home. The number of existing home sales in America is once again approaching levels that haven't been seen since the 1980s, when the population was half of that today. People who have locked in low interest rates are not going to sell their homes unless they are forced to, because if they buy a new home with a new mortgage, they will be paying twice as much out of pocket every month for the same place. A report by the Wall Street Journal found that even if people needed to leave their home to move cities, they were just renting out their home instead of selling it, because they could keep their sub 3% mortgage rate and charge record high rental prices. If you own a home right now, there is no reason why you would want to sell it. A flood of forced sales is much less likely today because lending standards are tighter than they were in the lead up to 2008, so most existing owners should be able to comfortably afford their mortgage. So, alright then, if people aren't going to sell the homes that already exist, we should just build more homes. This really is the answer. But according to the Department of Housing and Urban Planning, America is building fewer homes now than it was when we had half as many people. By now, I am sure you are all familiar with the problems caused by zoning, NIMBYism, and local building codes. These are all making the construction of newer homes slower and more expensive. A report by The Atlantic found that nearly half the cost of building a new home came from local rule and preferences rather than just materials and labor. There is another, even more simple reason why nobody is building new houses, and it's also the third reason why a real estate crash won't help you buy a home. A real estate developer needs to buy land, build a home, and then sell that home and land for more than they purchased it for. It's simple, but when land is so expensive, builders can't buy as much of it to build on. Back at the peak of home building in America, most of the operating margin was in the home construction itself. Now it's in the land, so even if a builder constructs a house on time and on budget, they risk losing money if the market swings by just a few percent against them. Builders typically fund construction projects with development loans, which are also expensive right now thanks to high interest rates. It's become a safer investment for developers to just renovate and flip existing homes instead of building new ones, because they can turn projects around faster and they don't have to deal with as much red tape. The only thing that could slow construction down even more is a collapse in real estate values, because if land prices are falling, then builders are not going to risk holding on to lands to build on. If you look at the data collected by the Department of Housing and Urban Development, you can see clear drops in new construction lining up with drops in home prices. Millions of people, particularly young people, not being able to afford a home is one of the biggest problems in America and a lot of other places around the world right now. But waiting for a crash to fix your problems will probably leave you very disappointed. In the last 400 years, real estate has gone from being owned exclusively by elite noble lords to something that the average family could buy. And now, it's becoming so expensive again that only elite landlords could afford it. But if the mortgage repayments are too expensive for most people, couldn't you just ask the bank to extend it to, say, 50 years? Well, that might not be the genius idea some people think it is. Late last week, the idea of a 50-year mortgage was not so subtly floated to the American public. Now, almost everybody immediately called this out for being a really dumb idea, and for a good reason. 50-year mortgages will effectively double the total interest people pay on their homes, they will undermine equity accumulation, it will make the housing market more rigid than it already is, introduce significant structural risks to the financial system. Oh, and this whole thing will just make homes more expensive than they already are. The average first-time homebuyer is now 40 years old. Adding on a 50-year mortgage at that age means that statistically, people will still be making their payments 11 years after they are dead. This is not to mention that if we still really thought it was worth trying, other countries have already done that for us, and the results were pretty disastrous. Now, you probably already knew all of these issues, but the problems that come with a 50-year mortgage go much, much deeper than this, and this raises two important questions. If 50-year mortgages are such a threat to our economic system, then how exactly did we decide that 30 years was the ideal? But perhaps the more important question is, if this is so obviously a dumb idea, who stands to profit the most by making it happen? So we have to get the obvious stuff out of the way first. And the biggest issue of all is that 50-year mortgages won't make homes more affordable. In fact, they will probably do the opposite. In a perfect world, being able to spread your payments out over an extra 20 years should lower your monthly payment. But even with the optimistic numbers, the difference would not be nearly as large as you might expect. Assuming a very competitive 6% interest rate on a $320,000 loan used to buy a $400,000 house, your monthly payment on a 30-year mortgage would be $1,919. If, however, you could spread that out over 50 years, then your monthly payments would fall to $1,685, a savings of $235 a month, which is not that much for almost doubling the total loan term and the amount of interest you will pay over the life of the loan. Most people have just pointed to this simple arithmetic and written the whole thing off as a big waste of time. But to play devil's advocate and give this the best possible chance of making some sense, some people will try to make the argument first that if you take those monthly savings and invest them into the stock market, your returns could be higher than your interest payments, letting you profit off the difference and putting you in a better financial situation later in life. Right now, less wealthy households overwhelmingly have their wealth tied up in their home. Of course, poorer households are less likely to own their own home, but they are even less likely to own a significant amount of financial assets. If people actually took these monthly savings and invested them diligently into the stock market, then not only could it theoretically improve the balance of wealth amongst lower income households, it could also make it easier for first-time buyers to get into the market in the first place. $235 a month invested over 50 years could be $3.7 million assuming historic market rates of return, which is over 10 times more than the additional interest a borrower would pay on their 50-year mortgage. However, that is if absolutely everything went perfectly. And I already know what all of you live streamers are saying to your chatters right this very second. Almost nobody taking out a 50-year mortgage is going to have this level of financial discipline. The reason I even bothered with the devil's advocate shtick at all is because if these financial products do come to market, this is exactly how they are going to be sold to people. You aren't signing yourself up for multi-generational debt. You are arbitraging the time value of money. Optimistically, people are just going to take the money that would have gone to repayments and use it to cover other areas of their household budget. Now this is optimistic because at least a bit of extra spending might contribute to economic activity. Realistically, all this is going to do is increase house prices by stimulating demand just like it has every single other time we have tried this. In just last week's video, we saw how longer and looser auto financing has made cars more expensive. The only reason why college kids with no income can pay for tuition that has outpaced inflation by 400% is because it's become so easy to take out student debt. More recently, everyday items have been allowed to inflate further than they might have otherwise been able to, with a little help from all kinds of weird and wonderful consumer credit. And yeah, even 50-year mortgages were introduced in Japan in the 1980s to assist with housing affordability. All it did was make real estate even more expensive, contributing to their record housing bubble. But that's fine, because it all ended super well for them, and their economy has been thriving ever since. So yeah, we may not like to admit it, but we have probably dug ourselves into the same kind of hole. For now, if we actually genuinely just wanted to make homes more affordable for first-time homebuyers, 15-year mortgages would probably do more good than 50-year mortgages in the long term, but more on that later. As for the benefits to first-time homebuyers, this is also ignoring the other costs that come with owning a home like property taxes, maintenance, and insurance, which means the total month-to-month savings will be even more marginal than even the optimistic estimates would suggest. It's also conveniently ignoring the fact that longer loans will probably attract higher interest rates from lenders, effectively eliminating the month-to-month savings for most people. From the numbers alone, this looks like a bad idea on top of a bad idea on top of a bad idea. And to be fair, most policymakers have acknowledged this and tried to distance themselves from this plan. But there are still two big reasons why we might end up seeing these loans anyway. They are going to make a lot of money for the right people, and we may be out of other options. So behind most bad ideas is either a profit motive or some level of desperation, and you don't need to tighten the tinfoil hats too tightly to see both of those elements here. The current proposal to introduce 50-year mortgages came from a meeting between the president and the Federal Housing Finance Agency director, Bill Pulte. The FHFA was established in 2008 after the global financial crisis to keep a tighter leash on Fannie Mae and Freddie Mac, the semi-government enterprises tasked with buying up mortgages off regular banks provided they meet strict criteria regarding lending standards. Theoretically, you could walk into your local Wells Fargo today and ask for a 50-year mortgage, and as a private business, there is nothing specifically stopping them legally. However, at the moment, these loans are extremely rare for two reasons. The first is that 50-year mortgages do not currently fit within the underwriting criteria of Fannie or Freddie Mac. So if the bank gives that loan, they can't sell it off to these organizations, and instead they have to keep it on their books for the next 50 years. Compared to a regular 30-year mortgage, which they can make a quick, easy profit on overnight, this kind of deal just doesn't make business sense, except for maybe rare instances of extremely large loans to private banking clients. However, if the Federal Housing Finance Agency instructed Fannie and Freddie to start accepting 50-year loans as well, then that would be the first barrier removed. The second reason why private banks don't do this for now is because 50-year terms are outside the bounds of what the Consumer Finance Protection Bureau considers a qualified mortgage. Qualified mortgages just means that banks meet some basic requirements to satisfy the Bureau that their lending is not predatory. If they do meet these criteria, they are offered legal safe harbor, which makes the banks harder to sue if the mortgage goes tits up. For now, loan terms beyond 30 years do not meet these criteria, which means if you get given a 50-year mortgage and end up in financial hardship, you could theoretically take your bank to court for predatory lending and they would have far fewer legal protections. Now, they would still have an army of lawyers, so please don't try it just because someone on the internet said it was theoretically possible. Anyway, this might not matter soon because the government is currently pushing to dismantle the Consumer Finance Protection Bureau anyway by cutting off its funding. This would remove the last barrier to 50-year loan terms, and if banks are allowed to write these loans, there is a big incentive to do so. Longer loan terms are more valuable when they are turned into mortgage-backed securities because they pay interest for an additional 20 years. Longer loan terms will most likely also enable slightly larger loans, maximizing bank revenue. Now remember, the Federal Housing Finance Agency back up here was specifically created after the subprime mortgage crisis to try and stop the whole system from getting too crazy again. So then why would they be pushing for riskier loans that are going to make the market more unstable? Well, we may never know. But on a completely unrelated note, the current director of the FHFA, Bill Pulte, is one of the heirs to the Pulte Group, the third largest real estate development company in America. He is also the founder of Pulte Capital Partners, a separate private equity firm he started in 2011, which according to their website makes focused investments into construction-focused businesses like roofers, HVAC installers, and drywallers. That means both the family business and the private equity firm are reliant on people buying and selling homes to generate returns. And that's a problem because home sales have cratered since interest rates have risen. New buyers can't afford to break into the market, and existing homeowners don't want to sell their homes after they locked in low interest rates. Now, if 50-year mortgages become commonplace, they would only make our current predicament significantly worse for future generations down the road. If people can lock in good rates for 30 years, that can cause problems. But eventually, they build up equity, and for the final 15 years of their loan, their nominal interest rate is not as big of a deal. However, if people lock in a 50-year mortgage at a good interest rate, they will build up equity in their home far more slowly, which means that the current rigidity of the market could be extended for the length of an entire generation. However, that will be a problem for a generation that isn't even born yet. And obviously, it should go without saying, screw those guys. We have problems to fix right now. Today, even those households that were lucky enough to lock in low interest rates on normal terms are starting to struggle. The true extent of financial hardship in the housing market has become incredibly hard to track because of a trend that is being dubbed extend and pretend. Basically, lenders have allowed borrowers to defer or renegotiate their payment schedules quietly behind the scenes without officially noting them down as delinquent payments. They extend their loan terms and pretend everything is okay. Now, for the lenders, it could be argued that some repayments are better than no repayments, but for the financial system as a whole, we truly don't have reliable data on how dire our situation is. For home builders and financiers, this is a real problem. But one way to get things moving again would be to make financing terms even more flexible. A 50-year loan is effectively just officially sanctioned market-wide extend and pretend. This could be sold as helping out new buyers break into the market, but the people who it will help the most are existing investors. One of the biggest problems with real estate around the world is that modern homes have become assets first, with a side hustle in accommodating humans as a distant second priority. This is because they are one of, if not the single most effective vessels for finance and tax incentives. You can't borrow money on a government-backed 30-year fixed interest term to buy stocks, nor can you claim any of the dozens of deferments, incentives, or credits that come with real estate. When it comes to reining in house prices to address affordability concerns, most people can only spend as much as they can borrow. So by restricting how much they can borrow, policymakers can easily influence home prices while also making the financial system more robust. A study on Swedish home prices found that properties become markedly more affordable after the regulators cut back on interest-only loans and introduced strict amortization schedules. A global study by the Bank of International Settlements found a similar trend across countries. If we really wanted to make homes more affordable, 15-year mortgages would do a lot more than 50-year mortgages. But that's kind of the point. Because real estate has become such an institutionalized investment vehicle, one man's affordable home is another man's crippling market crash. On one hand, 50-year mortgages are only going to make things worse by making homes even more attractive as an investment vehicle. But on the opposite side of that same coin, 50-year mortgages could help to keep a fundamentally broken market from collapsing on itself, even if only for a few extra months. Over the last 5 years, institutional investors have drawn a lot of scrutiny for quietly buying up hundreds of billions of dollars in residential real estate across the country, particularly in areas like the Sun Belt. Today, they are quietly trying to back out of those same investments because the markets they went all in on did not continue to attract the same volume of new entrants as they were projecting. As I was putting this video together, Atriarch did a fantastic interview with Melody Wright, one of the top housing market experts in America who has effectively been saying the same thing. Now, I will leave a link to that full interview because it's worth a watch. But to summarize, the housing market is shaking, so institutional investors with thousands of properties want to dump their holdings onto Airbnb bros with dozens of properties. But the only way they are going to be able to do that is if it becomes easier to qualify for big loans. And the only way to get those is if big loans are sold as a way to help regular people who just want to buy a single home to live in. Unfortunately, this market has become so large that they are effectively too big to fail. Actually letting homes become affordable too quickly would present a systemic risk to the entire financial system. Unfortunately, one group has to feel the pain. And it's just much easier when that group is the people who aren't yet balancing huge piles of debt and overinflated assets. Now, go and watch this video next to find out if the everything bubble can keep itself going forever. And don't forget to like and subscribe to keep on learning how money works.